Welcome to Spidell's California Minute. I'm your host, Catherine Sedan. This week we're covering how to treat insurance payments and other reimbursements received after a disaster. For a deep dive into disaster losses, including discussion of the Federal Disaster Tax Relief Act, how to calculate the gain or loss, involuntary conversions, and property tax relief, attend Spidell's 2-hour disaster loss webinar on June 10th. You can get details and register at caltax.com under webinars. When a taxpayer has property loss from a disaster, insurance and other reimbursements have to be subtracted from the property's adjusted basis or decrease in fair market value in determining the amount of the loss that can be claimed. A taxpayer that has insurance has to submit a claim in order to claim a loss unless the amount of the loss is less than the deductible amount. Other reimbursements that could reduce a taxpayer's loss include employers' emergency disaster funds, but only if these funds are required to be used to rehabilitate or replace property. If they can be used in any manner the employee chooses, they will not reduce the loss. And disaster benefits if they're required to be used for property repair or replacement. Payments that will not reduce the amount of a casualty loss include cash gifts from relatives or crowdfunding sources, even if they're used to restore or replace the property, and insurance payments for living expenses. If a taxpayer elects to carry the loss back and underestimates the amount of the insurance reimbursement, the insurance proceeds received that are in excess of the amount claimed on the return have to be included in income in the year received. For example, assume that Daniel's home in Los Angeles County was destroyed by California wildfires in year 2. His insurance adjuster told him that his reimbursement would be $100,000. Daniel's loss after the reimbursement was $50,000. Daniel elected to take the casualty loss on his amended Year 1 tax return, which he filed on the original due date of his Year 2 tax return. In late Year 2, the insurance company sent him reimbursement of $125,000. The additional $25,000 of insurance reimbursement has to be included in Daniel's adjusted gross income for Year 2 under the tax benefit rule. In a case where a taxpayer may have overestimated the amount of insurance reimbursement, for example, if the insurance company does not pay the claim, but the taxpayer had already reported the reimbursement when calculating the loss, the taxpayer should amend the return to increase the amount of the loss. A taxpayer who sues a city, landlord, insurance company, etc., should report any proceeds in the same manner as an insurance reimbursement. The proceeds would be taxable in the year received unless reinvested under IRC Section 1033. However, if the taxpayer had previously taken a loss and subsequently receives an insurance reimbursement or settlement, the amount has to be included in income under the tax benefit rule. If a taxpayer is sued as a result of a disaster loss, the taxpayer would recognize the loss or take the deduction in the year that the suit was settled. Treasury Regulations Section 1.165-1 states that, quote, "A loss shall be treated as sustained during the taxable year in which the loss occurs as evidenced by closed and completed transactions and as fixed by identifiable events occurring in such taxable year," end quote. Stay up to date on California tax news with a subscription to Spidell's California Tax Letter. This monthly newsletter is written by California tax pros for California tax pros with helpful examples and charts. For subscription information, go to caltax.com and click Publications. That's all for this week. Join us next time for another episode of Spidell's California Minute.